Hey everyone. Lee in the Facebook group asked, has anyone gifted equity to their children to buy them an investment property? Wondering about the pros and cons of this. Any advice would be welcome, please. Vince Scully from a live show, but welcome back to Retire Right.
G'day, Glen. It's good to be back.
Yeah, what do you take of this? Because there's probably 15 paragraphs of information that we need, but I just thought it's a good discussion point because I know a lot of people want to help their adult children financially. So how do you take this?
Obviously, this is a very personal matter, for some ways it's better that they have the money now than when you die. But I must admit, I'm a big fan of letting adult children stand on their own 2 feet. Sometimes they need a helping hand, but they should be allowed to give it a go themselves first. My deal with my boy, for what it's worth, he's now a homeowner in Victoria, was I said that if he can save his $5...
How old's your son?
He's 25.
Yeah.
And didn't go to uni. So my deal with him was I said, look, I'll pay your lender's mortgage insurance bill if you can save 5% and convince a bank to lend you the money. And as it turned out, the Victorian government was handing out money at the beginning of COVID and he ended up not needing my assistance. So my sole contribution to that deal was organising a 5-year fixed rate mortgage at 1.99%, which is just about to come off its
Well, he's about to get a bit of a wake-up knock on the door.
But he's had 2 flatmates helping to pay the bills along the way. So obviously everyone's different, and that was my view. But there's a whole bunch of
the interesting part of the question here, Vince, is gifted equity. Like, I wonder if they're talking about we've got our own property that has equity, which is the value on paper that, might be tied up. How do we gift that? And I think we need to fundamentally walk back a minute. And this is where I would love to ask Lee a million questions. Does the child want an investment property or is the parents wanting to do this to protect the kids? And this is like maybe they need a first home to live in. Maybe they need some money, pay the HECS and help that off, or maybe
they need to travel.
I like the intent, but there's other complexities that walk in the door as well. And we'll assume, Vince, that they might be 65 or 67 and just or I don't know, 5 years out of age 67. If they're wanting to knock on the door of any Centrelink benefits, the gifting will potentially catch them out, and whether you gift equity, however that works, or hard cash or property or shares, it will all get caught as a gift.
The one exception to that rule is the parental guarantee approach, where you guarantee the kids' equity. So they have to qualify for the loan on their own good, but you're going to provide a guarantee means they don't need a deposit. That can be a really good way, as long as you're comfortable with putting the family home or your investment property or the family home at risk. It does sort of quarantine the risk, and the odds are, since our home loan default rate is sub 2% in Australia, the odds are that you'll never actually have to stump up with the cash. But you could do. May leave you less able to recover something if the kids get divorced. It's unlikely to catch your gifting problem because it's presuming you're doing it on your family home. If you give them a property which you have some equity in, you might have some stamp duty, and of course the gifting rules might apply if you're close to age pension qualification. Handing over cash is another way of doing it, where if your kids aren't married, that's pretty clean and neat. If they're married, there's obviously issues. Well, do you want to preserve some of it in the event that they get divorced? And much of my take on this, I know this is unpopular in legal circles, but I don't think we should, as parents, and I think I can put myself in that category. It's it's an odd position to be making a gift to your kids and then putting conditions and ability to claw it back. It all just seems a bit distasteful to me.
So, so are you saying that in legal circles, when you give the gift, quote unquote, it's actually documented as a loan?
Or there's some security taken or some caveat or some documentation that it needs to be returned in the event of certain things happening.
Yeah. But if we go to whatever the situation is, Lee wants to give money to their adult children for an investment property.
Yep. It's your money. Do what you want.
I mean, the pros are you're giving money away and it feels good. You've wanted to help your child. That's all well and good. The pros can be as long as you need, it sets the kids up, all that stuff. So I just think the other side of the coin is one that we need to talk about more. Does the child want an investment property? Are you saying you need to buy an investment property, I'll give you the money, they're tied to this mortgage, it won't be positively geared? Is it actually causing annoyance to the child because they didn't really want an investment property? I don't know. They're kind of the red flag discussion things.
And looked at from the kids' perspective, because we obviously deal with a lot of people who are getting support from the bank and mum and dad to usually buy their first home rather than investment property, but works both ways. That, from the kids' perspective, is this giving mum or gran a perfect excuse to interfere in your day-to-day spending habits? And is Lee seeking to exercise those sort of things? Because it is quite easy to, at the Christmas barbecue, to go, well, what are you spending all that money on Uber Eats for? Oh, I've just given you $250,000. I don't want to see you pissing it up against the wall. So these are full of family dynamics. So this is as much a psychology question as it is a money question.
And I think you're right there with the gifted equity. It might be better to do a parental guarantee on the investment property if the kid does want a property. Or, as you did, just pay the LMI or whatever. I don't know.
And, of course, with the new government scheme, I wouldn't even have to do that. The government were going to stump up with the $30,000.
That's right. So anyway, my advice, because Lee said any advice welcome, please, just make sure that your child is on the same page.
Yeah.
Because
I think tread carefully is the answer. They might froth on getting a portfolio of shares as a gift, as an investment, and they might not. They could have, and we'll talk about this after the break, Vince, they could be a hardcore socialist or communist child who doesn't like investment properties because everyone who has an investment property is evil. Isn't every 18-year-old a communist?
I think so. And so it could be, it's like, make a number up. If you wanted to give $100,000 of equity, they might value $100,000 in shares or to see their superannuation, maybe not an investment property. My name is Glen James. You are listening to Retire Right with Vince Scully. Let's get into it right now.
This is a podcast that will help you plan and execute one of the biggest moments in your life. That's retirement. You'll learn how to set up your finances in a way that benefits you, your lifestyle goals, and keeps you in the know within this complex world of money and investing. Your host is Glen James, former financial advisor, author, and host of the popular Money, Money, Money podcast. Glen is joined by experts in various fields around the topic of retirement in Australia. Any advice in this podcast is of a general nature. Full details are in the show notes of this episode. You only retire once, so retire right.
Vince,
Glen.
we had a very, very interesting couple of days in the Retire Right Facebook group.
We certainly did, didn't we?
Now, if you want to be in on the action on the Retire Right Facebook group, when joining, just put in where it says, where did you hear about this group? Put episode 341 with Vince and Glen on YouTube or on the podcast so we know that you're not a bot. Now, a dealer's choice, Vince. Do you want to talk about Craig or Fick first?
Let's start with Craig, because that's a...
All right, what did Craig have to say?
Craig says he shifted 100% to cash only yesterday.
So we're recording this on Friday the 10th.
So that was the date, possibly the day before.
9th or the 8th.
And he says that Blind Freddy the world's greatest investor, can see there's a huge meltdown on the horizon. Gold is at a record high. The stock market is massively overbought. USA is virtually bankrupt. My super's made 7% since the 1st of July. Well, good on you, Craig. And now I've shifted to interest only for the balance of the financial year, and I'll recess then. I assume that means cash invested to earn interest.
Yeah.
What is everyone else's thoughts on the economy outlook? Well, let's just deal with the 3 points that he raises as the sign that blind Freddie should see that the crash is coming, and then we come back about the wisdom of his reaction to all of this. Yes, gold is at a record high and has significantly grown in the last year. When you look at it over the longer term, gold is up about 95 times, or at least it was the last time I looked. It's probably changed in the last few days. 95 times since you could first buy it in 1971. So the US came off the gold standard in
75? Two.
And it was illegal for people to own it for quite some time. And the price sort of ran up steadily and peaked in 1980 and then dropped off really quickly. So it hit this peak for like a week in 1980. And in inflation-adjusted terms, it's only just past that peak. So about a year ago, it passed that peak in inflation-adjusted terms. So gold is an important part of most people's portfolios, and most Life Sherpa Invest portfolios will have 10% allocated to gold.
I have got a Life Sherpa Invest portfolio, and I trust there is an allocation to gold.
And the rationale for that is not because it's gone up 45% in the last year. It's been there for over a decade, and it's been there because of the way it behaves relative to everything else. And you get that without giving up returns. So over that period I just mentioned, from 1971 to today, gold has delivered about 8% annual returns, which compares the S&P 500 in US dollar terms at about 11. So if you ignore the dividends, they're neck and neck. And so that's why gold's important. Yes, it's run up quite significantly. I'm not sure that's a sign of, back to this moment, I'm not sure that's a sign necessarily of an impending doom, but it's more a function of central banks rotating their reserve holdings. Much as, Australia sold ours out in, was it the Keating eras we sold all ours? Or Howard?
Sure. Not that old, Vince.
And
I look it, but I'm not.
A lot of central banks have moved back in, particularly the Chinese. So, although when I walked down Martin Place the other day, and there was a queue outside ABC Bullion.
Was that to buy, or are they people selling Nana's old jewellery?
You couldn't tell. ABC, this actually made the papers today.
Yeah.
And ABC Bullion were quoted saying mostly buyers, but some sellers.
Right. Okay.
But I wouldn't be reading into the recent spike of gold as the world's about to end tomorrow. Stock market is massively overbought. Well, inflows have been strong. The valuations are not actually overly stretched when you look at the risk-free rate and forecast earnings
But if you
growth.
carved NVIDIA out and some of the big AI stuff, like, sure, that there's probably a discussion there.
Yeah.
Maybe with the Mag 7.
Yeah, so the multiples on the face of it appear high. So if you apply them against the Shiller Cape Index or the Buffett indicator, historically you'd say they are high. But when you look at the current risk-free rate and what earnings growth might look like, they're toppy, but I wouldn't say they're particularly stretched. And your third point about the US being on the verge of bankruptcy, well, heads up, the US cannot go bankrupt. It is in control of producing US dollars. And before you Keynesians have a go at me in the comments, the printing money doesn't necessarily lead to inflation. Government deficits are simply the flip side of private sector wealth. You can't have one without the other. And the US has been running a deficit for more than 40, maybe 50 years. Certainly when I did my MBA in 1986, my thesis was on what they called a twin deficit problem back then, and everyone thought the world was going to end in 1986. And
Did it?
And it didn't, actually, surprisingly enough. And, of course, the US has run 2 surpluses in the 40 years between it. So I wouldn't say that the US has got a lot of problems, but the debt's not one of them, that the US government could wipe that out tomorrow by turning the printing button. Part of the reason why governments don't do that is because the markets need a safe place to park money, and it forms the basis of the risk-free rate. So you cannot get rid of the bond market, which is dominated by governments. The market needs the bond market, and the US is not going bankrupt anytime soon. Now, does that mean the market might not fall 30% tomorrow? No, I don't have a crystal ball, and we don't do predictions at Life Sherpa. Is it more likely to fall than it was yesterday or the day before? I don't think so. But it will fall 30% someday. I just don't know when. In fact, I don't know how old Craig is, but let's say he's close
55.
Close to retirement. He's got 40 years of life to go, and he will see 3 or more 30% falls in that time. In fact, every 2 to 3 years, we have a double-digit fall. So let's not get too hung up about this.
I think it's important, Vince, to note that if there is a 20 or 30% fall in markets, like, number one, have a look what happened in April with the tariff crash that lasted.
The Trump tariff tantrum.
Yeah, which lasted 10 minutes. Just because an indice may fall 20% in a matter of weeks, most of our listeners' portfolio is not in 100% equities, 100% international equities. So we need to be conscious of the fact that we've got balanced portfolios, and if a market falls 20%, it doesn't mean your whole log in and see your account fall 20%.
Yeah. But that assumes that people are diversified. And if you've spent as much time on Reddit or Facebook as I have, you will know the preponderance of 100% large cap equity portfolios. The classic VAS VGS VEU, that's 100% large cap equities. And that's all highly correlated. So that's not a balanced portfolio by any stretch of the imagination.
I saw a thing on Instagram the other day, and I'll take a screenshot and overlay it in the YouTube. Big trouble. Data trend screams recession louder than any economist, and it's looking since the last 20 years, the top Google searches in the USA.
Not that we have a long data series for that, time series for that.
That's right. So the spikes, you probably can't see it, but either way, it's like all of this stuff spiking over the last year. Sell my house fast, give car back, borrow against stock, borrow against life insurance, sell my Rolex watch, and bankruptcy lawyer. They've all spiked. And maybe there is a discussion, Vince, you've heard of Wall Street and Main Street. Like, is there a detachment from the two at the moment?
Yeah, there is arguably. I mean, if you look at the consumer spending data, both here and in the US, it's out of whack with capital markets. Craig lists 3 indicators that concern him. I mean, the one that concerns me more than anything is the preponderance of geared funds being launched. That is a sure sign of the fag end of a boom. Now, when the taxi drivers, or I guess today it's Uber drivers, in the 20s it was shoeshine boys, when they start spruiking stocks, you get this sort of thing. I went to my local 24-hour restaurant the other night for.
Were you at City View on Circular Quay or whatever it was called?
No, this is a bit more suburban than that. I won't name names because I'll probably embarrass the guy behind the counter. But I was wearing my shirt because I just come from a meeting, and he said, well, what do you do? And I said, I run a financial advice business. And all he wanted to do was talk about stocks and how he was a legend in investing. And I just had to nod and go, yes, mate. They're the bigger signs.
Yeah, I jumped in an Uber in Portland when we were at FinCon, and the guy's like, oh, what are you doing? I'm like, I'm at a conference. Because I hate saying it's like a money conference and all that. He goes, oh, I trade options. And I'm thinking, you must be very good if you're doing Uber.
That's right.
Anyway, I asked a couple of people on LinkedIn, and I didn't put Craig's name or anything on LinkedIn just to respond. Peter Diamantidis said, trying to outsmart the market is like trying to outsmart the ocean. If you paddle against every swell, you'll wear yourself out and still end up right where you started or even further back. The ups and downs aren't something to avoid. They're part of the movement that makes the progress possible. The very motion that makes you uneasy is also what creates the lift that delivers your return. Without that rise and fall, there is no forward momentum at all. The risk is what the return rewards. The trick isn't to fight the tide, it's to hold steady on the board, knees bent, and let the natural movement work for you. Another, Neil Benson, this is what happens when people who still listen to Robert Kiyosaki.
Who's predicted 10 of the last 2 recessions.
That's right. And Jeremy Taylor on LinkedIn, he's not a connection, but he's put on my post. And this is a good quote from Peter Lynch.
Yeah, I love this quote.
More money has been lost by investors preparing for corrections or trying to anticipate corrections than has ever been lost in corrections themselves.
That's absolutely true. Because the problem with this approach, even if you're right, being right once isn't enough. You've got to be right. You've got to be right about getting back in as well. And that's where most people fall down. So if you think Craig's probably old enough to remember 2008, but if you think back to 2008, right, we had the big drop in September 2000. Well, we had a gentle drift down through late 2007, early 2008. We had the big fall in September 2008, and then it kept slowly drifting. It didn't actually bottom till 2010. So, would you have jumped back in through 2009 and compounded your problem? Or would you have waited till 2011, 2013 when you'd have missed out on the first 20% of the correction of the recovery? So it's a really tough gig to pull off. And you asked me a few months ago, what are the 3 attributes of a great investor? And I said something along the lines of patience, humility, and opportunity. And this is where humility matters. Yeah. If you start believing that you know more than the market, you are heading for a fall.
Yeah.
And
so in bringing this to a point, if you're out there and you are reading crap online, you're seeing Instagram posts that I see and I've just shared, and we don't react to anything in our life out of fear, be it investing, be it relationships, be it anything. You start doing things out of fear, things will go wrong. The second thing is you need to have a strategy for your financial life. Now, this could be a good time to call your super fund, log in, see how you're invested. Use this very time to think, all right, I need to learn what I'm invested in and just get dialed in. You probably don't, if you've got your super set up and you've not touched it for a million years, it's not going to be in 100% growth anyway. And I would hypothesize if you are 60 or even 55, you are still going to need that money to be put to work for the next 20 or 30 years. Now, what does it matter if my account fluctuates a little bit here and there over the next 12 months when I look back in 20 years' time? It's a blip. It's a non-event. We just need to zoom out. When in doubt, zoom out.
But it is, if this is your gut reaction, it's probably a sign that your portfolio is not aligned with your risk profile. And risk profile is a function of your tolerance for risk, your capacity to recover from it, and your need for risk. and you've got to take all three of them into account. And so, when it comes to investing, at the risk of sounding like a broken record, that growth's important.
You look like a broken record as well.
But if some is good, more isn't always better. And you've just got to align it to your needs.
Yeah.
And if you feel the need to go to cash, it's probably because you're in the wrong portfolio in the first place.
Vince, I've never met somebody who has, over a period of even 15 years, tried to do this and actually had a success story. They usually end up staying in cash for too long.
Yeah, that's usually the problem.
Because you don't have the stones, you're just still waiting, you're still waiting. And the market will move on and you'll miss the boat. Now, do what you want, but this is a good idea to get financial advice. If you're one of our angry followers who don't like us because we are pro financial advice, call your super fund, get some free advice from them on your portfolio. Just get engaged and don't do anything dumb. Because if you start dicking around and moving your super to cash and I'll put half here and half there, it's only going to end in tears. And if you're still working, Craig, if the market is correcting and it does pull back a little bit, guess what? Your employer contributions are buying in at a lower unit price anyway. So there's that. Anyway, we'll take a break and we'll be back right after this.
If you're after personal financial advice, don't get it from a podcast. If you would like help based on your own personal situation, head over to retireright.com.au, click Get Help, and we'd be happy to introduce you to one of our trusted professionals. Our panel of vetted financial advisors and mortgage brokers work with people all over Australia, so they can connect with you wherever you are. That's retireright.com.au and click Get Help.
Okay, Vince, this is a very, very, very interesting little comment from Fick. Love your shows, Glen. Almost always good advice.
Is that what you call damning with faint praise?
Yeah. Oh, and actually, before I move on, shout out to Darwin, who works at Bunnings at, where was I? Kingsgrove, of all places last night, Vince. I was at Bunnings,
I'm surprised
Kingsgrove.
you even know where it is.
Man, that's
Did you take a wrong turn on Anzac Parade?
Yeah, far out. Anyway, I was in Bunnings at Kingsgrove last night, and I was in the aisle looking for some BP connectors, and Darwin came up to me, one of the workers. I'm like, hey, could you tell me where the BPs are? And he goes, oh, I watch you on YouTube all the time. I'm like, well, thanks for listening. And so thanks so much, Darwin, for saying hi at work.
So you went long BP connectors, did you?
I really did. No, just the single pole ones. Fick, love your shows, Glen. Almost always good advice. However,
There's always a however, isn't there?
The Money, Money, Money podcast on tax reform. Very frustrating listening to the lady saying, keep your holiday house, no one's forcing you to sell it. When land tax in Victoria is forcing families to sell their long-term family home that could have been in the family for 2 to 3 or 4 generations. E.g., family purchased 50, 60 years ago in Sorrento, an old beach shack for $50K. Doesn't really matter the purchase price, but it's now worth $3 million. Land tax, because it's not a PPOR, close to $30K every year, not including rates, insurance, etc. No idea what she's talking about on your Money, Money, Money podcast. Get up to date before getting these people on talking such rubbish.
Yeah.
So that was Jess Brady when we did our campfire chat.
Now, I can't remember precisely what Jess said, but I do recall the discussion, and I think I had my own tuppence worth to put in here. I think the point that Jess was trying to make, without going back and listening to it, was that tax is there to not only just to create revenue, but it's also there to create incentives. And but you don't have to follow the incentives. So I think Jess might have been, I don't know if you got a better recollection, but it was probably
it was a 2.5 hour chat with the three of us.
Yeah, okay. But the point I was making, and this is a problem with reform, tax reform, one person's tax reform is someone else's tax increase. And there is no doubt that in Australia we have a not a particularly high tax take by global standards, but it is terribly skewed to income. And most economists and most sensible people would suggest that that's probably not a good idea and that you want to spread the base a bit. So now, when you do that, where do you go? And land is a perfectly economically sane place to impose taxes. If you just go back and read Gresham's work or the Georgians' work, this is not a new concept, that taxing land, in particular, the increase in the value of land that comes from rezoning, is a sensible way to tax and recover some of the wealth that accrues to what amounts to a government monopoly granted to an individual or a private company.
Yeah.
So I've not got a lot of sympathy for people with a $3 million house
and I was actually
about paying $30,000 in taxes.
I was going to say, let's just make two statements. 30,000 foot view, someone's got a holiday house worth $3 million and they're whinging. You might not get much sympathy out there in Main Street. Sure, I get the sentimental, generational, passed down, inherited and all that. But a couple of things. Number one, it's Victorian state tax. We all get the politicians we deserve, and everyone in Victoria with all these savage land tax. It's like the worst state in Australia now, isn't it? You all voted that government in. Like, if you don't like it, change, vote them out. Not that they're probably going to remove land tax. But secondly, we're here now. This is the lay of the land. We need to come together, and I don't know if it's been in the family. I don't know if it's your direct family or if it's in 3 siblings' names, but let's, instead of saying get a guest on who knows what the friggin' hell she's talking about, what about you say, well, this home is important to us, so let's actually sit down and have a meeting. This is where we find ourselves in this economic climate. We've got some decisions to make. 1, we sell it. Probably don't want to because of the family nature of the house. 2, can we all, there's 4 siblings who own it, we all have to chip in, okay? Might have to do that. 3, can we say, well, it's in Sorrento, let's put it up, we're going to have to sacrifice, can we get $30,000 worth of revenue from renting it a few months of the year? Maybe, don't know. I think before we hit record, Vince, you talked about reverse mortgage. Can we use equity in the property to fund itself? And I don't know, I just think, number one, and I did write back, the show's worth what you paid for it, and so are the guests. And then I think someone else was like, well, sorry that you got a dismissive comment. I mean, most people, it's hard to react when someone's like, hey, Glenn, you got shat guests and pull your head in. And there might be, some tongue-in-cheek and, like, I don't care, go at me. But, yeah, I just think, well, what do you do? This is the situation you're in.
Yep.
I don't know I reckon if I called 10 people right now and said, hey, what do you think? Someone's got a $3 million holiday house and they're whinging about having to pay some land tax each year. Is that crap or not? I reckon 10 out of 10 will be like, yeah, they can pay it or get rid of the house. I don't know. Can we? I just don't know. That's why I just, get up to date before getting these people on the show talking rubbish. There's always going to be a diversity of opinion and view. I want you to disagree with me and my guests, because the minute that this is an echo chamber and we're all filthy capitalist pigs or we're all commies, it's probably going to be a bad day. We actually did get another email about that episode, Vince, that Jess was a communist and I was a woke tool.
Where does that leave me?
You weren't mentioned, Vince.
Oh, maybe no one was listening to me.
Actually, Alicia Aitken Radburn messaged me. She said, oh, that's funny. Vince was there to level you two out.
Was usually I'm the grumpy old man in the corner.
I don't know. Any final comments on that?
I just go, I have zero sympathy for someone with a $3 million holiday
But
house.
even about the warm and fuzzy family heirloom generational thing.
You've already inherited it tax-free, so we don't have inheritance tax in Australia. So presumably whoever bought this bought it pre-1986.
I'd imagine if it's 3 or 4 generations.
So you would have inherited a cost base equal to the market at the death of the last person who died. So really, guys, I think you've had enough subsidy from the taxpayer. Tell that to a 25-year-old trying to buy a house. I have zero sympathy for this.
Yeah. And that's funny. Imagine whinging when you've got a $3 million asset that you can't pay, what's the math, 0.1%?
Is it 1% or 0.1%?
We're having an aneurysm.
Oh, yeah. It's Friday afternoon.
It's true. Well,
but either
10%
way,
would be $300,000.
Yep.
So 1% would be 30. Yeah.
Yep. So, wouldn't have to rent it out very long to pay for that, which might solve some of the housing crisis. I cannot recall specifically what Jess said, but sounds like this is a little bit unfair. And if I wasn't an old grey-haired bloke, I'd be able to pull the misogyny card on that, which I won't.
Mike, I'm 65 but planning to work another 3 years. If I open a pension account now, I understand that I can't add further money, but I can open a new one upon retirement. So Vince, talk to us about these account-based pensions that sit inside the super realm.
Yeah. I'm not sure why this one creates so much confusion, but it does. And this is a fairly common trope both in the retirement and in other age pension groups that I spend time in for my sins. So that when you get access to your super, you can do one of 3 things with it, generally. You can take it out as cash and take it down to Randwick and put it on race 3 or something else. Maybe you could pay the land tax on your house in Portsea. Or you can start what's called an account-based pension. An account-based pension is another account, and that account attracts a zero tax rate. And you must withdraw a minimum amount of money, and that income is tax-free. That's an account-based pension. And that money has to be segregated from money that's in the accumulation phase, which is taxed at 15% on the earnings. So when you start a pension, an account-based pension, the income stream begins when the money goes in and you cannot add to it. You can have as many super accounts as you want.
And you can have as many account-based pension accounts as you want as well.
And then, of course, the third thing you can do is buy a lifetime income stream, like a lifetime annuity or a market-linked annuity. But that's probably a story for another day. But the key story here is, as many accounts as you want, but you can't add more money to the account that's supporting a pension.
So in practice, Vince, Mike's 65. He could move all his money to pension phase because he's over 65, regardless working or not. He might keep accumulating through his employer for the next 5 years. When he's ready to hang up the tools, his advisor will either say, let's recommute, wind back the pension and then add the money and start another one, or just start a second one. It's pretty basic. Don't get too hung up about it, Mike. The thing is, you're over 65, and in that age with the super world, in terms of accessibility and options, they're all there. So no issues.
And it's difficult to conceive of too many circumstances where he shouldn't be starting an account-based pension. There are some, but they're very obscure.
Yeah, absolutely. Well, we might leave it there. Thanks for hanging out with us this week, everyone. A bit of, what else is happening? Bit of an update. We've got Centrelink coming back into the studio soon.
Isn't it bizarre that guy's name is Bot?
Yes. It's better surname Bot than Robodebt.
That's true.
Justin's
But my name's Bot and I work at Centrelink.
So Justin's coming back to the podcast. So I'll get him to do a couple of episodes, and he was a wealth of knowledge.
He was great.
Funny thing, Vince, when he was talking about the FIS, Financial Information Service,
Yep.
how wonderful it was and all that stuff, I thought, wow, that sounds amazing. I had not much to deal with it. We had a few comments from people. I was like, we just did not have the experience that he was saying. So there might be a difference between, what they say that happens and what happens in reality.
Yeah. I mean, I hear lots of bad stories, but my personal experiences have all been positive.
Yeah. And that's why I hadn't had too much to do with it. But
well, you've got a while to go before you...
I got a little bit to go, Vince, a little bit.
But you look after mum and dad, I assume.
Oh, yes.
And did you do Centrelink work when you were an advisor?
Oh, not heaps. I really, a lot of my clients that I had that were pre-retirees and that went into retirement, they were either not eligible for Centrelink yet, so it was more setting up ready, or secondly, if they were over 67, they were self-funded anyway, so they just weren't on the Centrelink radar.
Yeah, but so my experiences have all been positive. I mean, they're not financial advisors, though, to be very clear.
No, but that's the trap, because I think people think when they get the scenarios that it is advice. And you can scream until you're blue in the face that, everything we say on this podcast is general advice and this is not advice. There are still people that will hear what we say and what they hear as Glen says this, Vince says that, Centrelink said to do this.
Yeah,
so
because there's a difference between what the dictionary says advice is, with a small a, and what the Corporations Act says advice is. And that's sometimes a little bit of a difficult mental leap to make, that you and I live and breathe this stuff all day, every day, and we think capital A advice, as defined in 766, 761, and that's not how the reader of the Australian or the Sydney Morning Herald naturally thinks.
Yeah, 100%.
And it's not any disrespect. It's just that's not what you're paid to do.
But also, anyone who listens to Retire Right, it's a really good audience, you guys out there who watch and listen. If you want to send me any feedback, good, bad, or otherwise, just go to the Retire Right website, click contact us. We'll see them all. We get lots of complaints and whinging.
Brickbats and bouquets, I think, is the technical term.
Yeah. So look, just reach out. I'm not above anything. We're not going to get it right every time. I might be woke. Vince might be a filthy capitalist pig. Jess might be a commie. But we just want to provide infotainment and really encourage everyone to pay attention to their own financial situation leading up to retirement. We'll end it there. My name is Glen James, joined by Vince Scully from Life Sherpa. Vince, we'll see you next time.
Bye for now.
Any advice is general financial advice only, which does not take into account your objectives, financial situation, or needs. Because of that, you should consider if the advice is appropriate to you and your needs before acting on the information. If you do choose to buy a financial product, read the Product Disclosure Statement, PDS, and Target Market Determination, TMD, and obtain appropriate financial advice tailored to your needs. Simo Interactive, Pty Ltd, and Glen James are authorised representatives of Money Sherpa Pty Ltd, which holds Financial Services Licence 451289. Martin McGrath, Financial Edge Group, and its employed financial advisors are authorised representatives of Synchron Advice, AFSL 243313. Opinions or comments from any guest on the podcast are theirs, and not those of the hosts, the publisher, or their respective licence holders.